It took 5 years for the perniciousness of inflation to filter down to the taxpayer, the investor, and the saver. And I see that same circumstance in front of us today. People won't react to inflation until the compound impact of that inflation crimps substantially their standard of living.
Today, we have someone I've been very much looking forward to interviewing on the pod. The man, the myth, and the legend, Mr. Rick Rule. Rick, thanks for joining us.
Flattery will get you everywhere, Aaron. Thank you for that kind introduction.
Of course. So there are a ton of things I'd love to chat about, but I want to stay focused today. I want to get into your investing strategy given the inflationary times that we are in. But we do have an audience, myself included, that loves junior resource investing, mining stocks in particular. You're obviously a wealth of knowledge in that department. It would probably be helpful if you could briefly explain kind of how and when you got involved in buying mining shares. Because if I remember correctly, you started out as a young man in real estate investing, wasn't it?
I did some real estate investing, but I went to the University of British Columbia in Vancouver, which was and is the heartland for the highly speculative junior sector.
Yeah.
And my intended major in university was natural resource finance. My first business endeavor, because I had to have a job to go to university,
Yep.
And because my only transferable skill was the fact that I was big, was that I became a bouncer in a bar, and through an odd set of circumstances came to own a bar. And that bar was sort of the epicenter of the speculative financial establishment in Vancouver. So I came to learn the mining stock game very early and really surprisingly thoroughly. I learned more by pouring alcohol for the players and debriefing them in the bar than I ever did in university. I utilized the free cash flow from my hospitality operations both to buy duplexes and triplexes, which is to say revenue properties. Mm-hmm. The idea there being that my cost of capital with a fixed mortgage stayed the same, while the yield would increase over time, and also to learn the knowledge that I had, the technical knowledge that I had from university, and the practical knowledge I had from getting the players drunk to speculate in natural resources. And the truth is that I did very well from both disciplines.
So what was your first big win in the space? When did that come? Did it come through a little bit of trial and error like it has for me, or did it come quickly?
No, I was very short-term lucky in that the first two deals I did were big winners. Mm-hmm. And long-term unlucky because I thought as a young man it was an easy game and I understood it. I didn't realize that I'd gotten lucky. Mm-hmm. My first deal was with a legend in Vancouver named Don McLeod, who happened, not surprisingly, to like to drink. And North Air Mines, which was that deal, if my memory serves me correctly, my average cost was about 10 cents, and it went just immediately to $1.50. That was pretty cool, you know.
Was that up in Timmins or?
No, it was north of Vancouver, at a place called Brandywine. Alcohol seems to run through this whole conversation. But Don had discovered a small high-grade deposit up there, which he put in production. The market responded well. And the second thing that happened to me, which was unbelievably lucky, is that a lawyer in Vancouver who liked me introduced me to a very strange Swedish guy by the name of Adolf Lundin, who went on to become perhaps the biggest player in junior mining. And we did a deal there called ChemGold, which turned into Glamis. And it was a very odd circumstance. It was I won't describe the whole transaction. Suffice it to say, it worked out even better than North Air, which was a 15-bagger. The consequence of those two transactions is I came away thinking that mining was a very good business and that I was very good at it. And I spent a while unlearning that lesson.
I bet.
Since you asked me for my first incarnation in mining, I gave you two, which were both very good. The truth is that the whole decade of the 70s worked out well for somebody who was in natural resources, particularly for somebody who was in the epicenter of natural resources like I was. And if you develop the ability to differentiate, as I came to learn to do, between the good, the bad, and the ugly, it was difficult to lose money. Now, after the decade of the 70s wore on, I didn't understand that markets worked and that the cure for high commodities prices was going to be high commodity prices. So in the early part of the decade of the 80s, when that market collapsed, I collapsed with it, which was useful too. I learned that markets work, and I learned just how smart I was, which is to say not very. And the scars that I got from the market collapse served me well for the next 45 years. So I'm actually happy about all of it. I'm happy about the early successes, however I misinterpreted and misused them. I'm grateful for the market collapse, despite the fact that going from being a very wealthy young man to having a negative net worth in the early 1980s was an extremely, extremely painful process. But the lessons that I learned from both of those experiences have served me and then my clients well for 4 decades.
I bet. Well, I appreciate you giving us the rundown. You mentioned the 70s. The 70s was an inflationary period. We stand in what I think is a similar situation. Now, I only know from the history books and reading. How does this decade or these last couple of years compared to the 70s? Is there any similarities?
In some ways, eerily similar at the macro level. Similar because the setup is so much the same. In the 50s and 60s, we lived through a period in North America that was just spectacular, a very benign climate, not unlike the period 1982 to 2022. And investors were schooled not to worry about anything, to buy the dips, that life was just going to get better. The Nifty 50 of the 60s was so much like the big tech stocks in terms of the cult around them and their performance that it almost gives me nightmares. At the same time, even as a high school student, beginning in 1967, it was apparent to me that inflation was on the horizon. We in the United States fought 2 wars, the war in Vietnam, which we lost, and the war on poverty, which we lost. And the consequence of that is that we were left with unsustainably high government debt. Raising taxes enough to accommodate that debt was politically unpalatable then as now. But although the writing was on the wall around depreciation, people ignored that writing for 5 years because they had been through a period of 20 years of benign economic climate, like we have. It wasn't really until 1972 or 1973 that the compound impact of inflation began to catch people's attention. When they noticed the price of a gallon of gas go from 20 cents a gallon to $1 a gallon, the price of McDonald's hamburgers going from 5 for a buck, which is to say 20 cents a burger, to 75 cents a burger. And they didn't see their wages or their interest income rising that rapidly. It took 5 years for the perniciousness of inflation to filter down to the taxpayer, the investor, and the saver. And I see that same circumstance in front of us today. There is an academic interest in inflation, but people aren't reacting to inflation. People won't react to inflation until the compound impact of that inflation crimps substantially their standard of living.
And tying this all back, and I'm very curious about this in the 70s because for reasons that you explained, but do you see, because I can see it in the daily economy, just in my daily my daily routines, you see, and friends and family and so forth, that lifestyles are beginning to change. They're beginning to tighten the pocketbooks. Now, how does that... Inflation is good for commodities. We know this. But how does a deteriorating amount of disposable income impact junior mining stocks, for example, their liquidity, the participation from the retail investor?
What you see is that although the overall pool of savings available to invest declines, and although people adopt a risk-off rather than a risk-on posture, that the market share, particularly of precious metals, but also resources generally, but particularly precious metals, increases dramatically. Let me give you some statistics. It is estimated that the market share of precious metals and precious metals-related investments, securities, in the American market, the U.S. market, is about 1/2%, which is to say that 1/2% of the total savings and investment assets in the U.S. dollar, in the U.S. market, are precious metals related. The 4-decade mean is estimated at 2%. So if the market share of precious metals relative to other asset classes merely reverted to mean, demand for that asset class would increase fourfold. It is estimated, although there's no statistics to corroborate this, but estimated by J.P. Morgan Chase, that the market share of precious metals and precious metals-related securities in 1981, the height of the boom, was somewhere between 6 and 8%, which is to say 12 to 16 times the market share that that same asset class enjoys today. With regards to the penny stock market, the junior stock market, what you need to understand is that coming into the decade of the 70s, that market was so small it almost didn't exist. The combined market capitalizations of the Denver Exchange, the Salt Lake Exchange, and the Vancouver Exchange were minuscule. And when the generalist investor came into that space, there wasn't enough market cap in the space to hold the money. And so you had what was almost organic growth of what were extremely junky companies. Junior capital markets today are much larger and much more sophisticated. There's institutional presence. There's all sorts of infrastructure. And despite the fact that the capital pools are much smaller now than they were 4 years ago, they're infinitely larger than there were at the beginning of the decade of the 70s. So I think in a macro sense, you will get tremendous help from an incipient fear of inflation that becomes an active fear of inflation. The idea that you get the penny stock melt-ups that you enjoyed in the early part of the decade of the 70s probably doesn't happen. An example would be Coeur d'Alene Mines. If my memory serves me well, in 1971, that was a 10-cent stock. In 1980, that was a $65 stock. You are not going to see many performers like that. And
Why do you say that? Why do you say that?
Because there's too many. The market caps now are too large. Legitimate silver juniors now sort of have 150 million market caps. To take them on a 60-for-1 ride suggests that they would have $20 billion market caps, and I think that's fairly illogical. I do think that if you, as an example in the silver space, which is still very unloved, if you put together a portfolio of sort of 10 high-quality silver juniors, I would suspect in the 5-year time frame, it's very likely that you'd be looking at a triple, maybe better. That's not the same as 60 to 1.
Yeah, very different. Rick, you say high quality, so this is where I've been investing in junior mining stocks now for almost 20 years, and right. I've been following you for about half that time, and you kind of, at least to me, coined the phrase "nothing pays like discovery."
Right.
And so you can't. Some of these names that I've invested in, I wouldn't say were high quality at the time. They were gambles. Right. And sometimes you have to take you have to take those gambles to get those big paydays. When you say high quality, what are some of the attributes of a high quality, say, silver company?
Well, let's go back and look at what you just said. You need to risk capital that you can afford to lose. Mm-hmm. And you need to invest psychologically in having enough staying power to accept both risk and volatility. Most speculators don't have that, or most would-be speculators don't have that. Mm-hmm. And you also have to be willing to do work. Most speculators in my career serving speculators follow the methodology, got a hunch, bet a bunch. And that doesn't work. It just doesn't work. So what makes a high-quality exploration speculation? First of all, people. A very small group of people generate all of the utility in junior mining. They aren't necessarily good promoters. There's probably 150, quote, silver stocks that pollute the junior mining sphere. And of 150, 135 are valueless at any market cap. So you want somebody who has been successful, if they're in silver exploration, at silver exploration. In other words, you want somebody whose prior success is relevant to the task at hand. If you have a great promoter who failed in crypto, and they failed in pot stocks, and they failed in lithium, what's the probability that despite their storytelling capability, they're going to succeed as silver explorers? I would suggest it's low. The second thing is you have to look for silver in places where silver exists. And so if you're skeptical about investing or speculating in Mexico or Peru, you have disqualified yourself from the two premier silver exploration grounds in the world. If you decide that you would rather invest in silver in places that you consider to be more politically secure, say Montana, where they've outlawed cyanide leaching, the probability that you're going to succeed is almost nil. The third thing I would suggest is that the exploration target has to include very good geology. To understand that, as a speculator, you need to understand or have access to somebody who understands geology. Specifically, low-grade silver deposits, while they're sexy, don't work. Grade pays, tons cost. So large, low-grade silver deposits have wonderful stories in terms of the per-ounce total relative to market cap, but those ounces never get turned into money. The rock has to pay. Mm-hmm. It's important that the rock pays. When you combine those three things, prospectivity, size and grade, and expertise, then you begin to narrow down into the high-quality silver speculations. Excellent. The rest of it, in colloquial English, mostly bullshit.
Shooting straight. I love it. I love it. Okay, so I want to touch on gold and copper in particular.
Yep.
Because they've all, obviously, as you know, been on great runs. Copper's, hitting a market that, Goldman Sachs came out this week, said would be extremely tight in the years ahead. Many are forecasting huge deficits in the future. Gold, obviously, is at or near a nominal all-time high. I still haven't seen many, and by haven't seen many, I mean probably less than 5% of all publicly traded issuers that I follow, that have gone on a run, say sub $100 million market cap, since the underlying metals they are going after, copper and gold, or copper or gold, have ran. Why do you think that is? Why are juniors still not really moving?
That's simple. Most juniors are worth nothing. If you merged every junior mining company in the world, there's probably 3,000 public companies, into one company. We'll call it Junior Explorco. That company in a very good year would lose $2 billion. In a bad year, it would lose $10 billion. So what's the sector worth? What would you pay for this company? Would you pay 8 times losses? 12 times losses?
I see.
The truth is that maybe 10% of the issuers have any value whatsoever. I'm not encouraging you to be pessimistic, because those 10% generate so much performance that they add legitimacy and sometimes luster to a sector that cumulatively loses $2 billion a year. Let's look at the sub-$100 million market cap space, the explorers. The fact that you're looking for something doesn't suggest necessarily that you're going to find it. If the price of copper goes up, but you don't have any copper, why should that impact the value of your stock? Let's say that you have Amalgamated Moose Pasture Copper Company. Amalgamated Moose Pasture is looking for copper. They don't have any copper. If the price of something that you don't have any of doubles, it doesn't impact your value very much. It might impact the sentiment around the story that you tell. And investors are coming to cotton on to this. Investors have been, at the very least, misled for 40 years. And I realize there's a whole young set of investors coming up looking to be swindled again. But the older school of investors doesn't need to be swindled again. They gave at the office last time. And I think that the market's going to be much more discriminating.
But let's say some of these names that I'm talking about, I mean, they have resource estimates indicated. They have, in some instances, pre-feasibilities and feasibilities, and even they aren't moving. And that, maybe to your point, tons cost a lot of money to move, and the grade just isn't good enough.
The copper names that I have been following have been doing very well. Now, they're probably names that are more advanced.
Right.
There is also some skepticism around the copper market in particular that says supply deficits are inevitable. There's nothing we can do. We needed to begin investing 30 years ago. So we're 30 years late, right? But you can have supply shortages if you have demand shortages, which is to say if we run into a recession, the copper price for the next 5 years doesn't have to go up. I'm not an economist, Aaron, so I can't say if we're going to have a recession. I'd leave that to your viewers. But if you're concerned about the economy, you need to be concerned about copper. I think in fairly long term, and I know that on a global basis, we need to replace one Bingham Canyon, the largest copper mine in the United States, every year to maintain current production, not to add new production. Given that I don't know if we're going to have a recession or not, I deal with the facts at hand. The facts at hand tell me that there are 1 billion people on Earth with no access to primary electricity. Another 2 billion people on Earth with access to only intermittent or unaffordable electricity. Those folks want to live like you and I. We live energy-dense lives. To deliver and to employ electricity to those people takes copper. We don't have enough production to maintain our copper usage, much less theirs. So with the facts at hand, understand that we could have a recession. I'm a copper bull, but it's a probability, not a certainty. Looking at gold, we have a very different circumstance. I think it's less economically dependent in that sense. Gold has done well when savers and investors are concerned about the maintenance of the purchasing power of their savings in fiat instruments, primarily in the world's reserve currency, which is to say the US dollar. As we said at the beginning of this interview, people are unconcerned now because they've lived through 40 years of benign economic climate. I believe that 40 years ended in 2022. And I believe over the next 3 or 4 years, the seriousness of the situation confronting US dollar savers will become apparent. It's already become apparent to savers in Canadian dollars, Australian dollars, euros, yen, renminbi. But I think it'll become apparent to US dollar denominated savers over the next couple of years in spades.
One thing that I looked at as kind of an indication that, Americans are already concerned about that, even at the retail level, is the sales at Costco of gold, 200 million a month estimated. Does that not indicate that the public is waking up?
Waking up is the right phrase. The last 3 years, you have seen last 2 years really, you've seen a pretty good increase in the gold price from, say, 1,800 US to 2,300 US. During that period, retail gold holdings, measured by the holdings of physically oriented exchange-traded trusts, in the United States and Europe have declined. There have been net sellers, retail holders have been net sellers in North America and Western Europe until 5 weeks ago. The increase in gold buying was really a function of foreign central bank buying, itself more a function of the weaponization of the US dollar than fiscal concerns. If you layer that foreign central bank buying, which shows no signs of abating, with the traditional gold buyer, which is to say, if I'm correct about the increasing realization of the perniciousness of investing, the same type of realization that occurred in the middle part of the decade of the 70s, that's the recipe for a truly explosive growth in the gold price. You know, I'm interviewed in podcast sessions like yours, particularly live ones when there's Q&As with the audience. And the audience that has bought into the gold narrative will say to me, well, Rick, when will the gold price move? And I look sort of studious, you know, and I say, I think the year 2000, it moved from $250 to $1,900. It moved 8.6% compounded for 24 years. In other words, it did its job. But they're looking for a precipitous move. The fact that gold did its job and shielded you from inflation doesn't count as a move. So I say, okay. Then it moved in 2023. It's gone from $1,800 to $2,400, a 20% move in the gold price. That doesn't seem to be enough either. Now, the truth is that I own gold because of the Y2K move. I own gold because it's given me 8.5% compounded for 24 years, which is pretty attractive for an old goat like me. But I believe, or rather I'm afraid, that those people who want a more dramatic move are going to get what they want. I don't think that a move to $7,000 or $8,000 or $9,000 is out of the question. I don't think it's going to happen. But I remember in the period 2000 to 2010, the gold price moved from $256 an ounce to $1,900 an ounce, a seven-fold move. If you view the current gold market in that lens, then a more dramatic move is probably in the cards. And if you look farther back for an analog, in the decade of the 1970s, what really caused the move was the devaluation of the U.S. dollar. We went into that decade with unsustainable debts, and we dealt with the unsustainable debts by depreciating the purchasing power of the currency that the debt was denominated in. We reduced the purchasing power of the United States dollar via inflation by about 85% over the decade of the 1970s, which is precisely what I think happens in the coming decade. And while I don't think that the result in the gold price will be anything like the 30-fold increase that we saw in that decade, a triple doesn't seem out of the question to me at all. No guarantee it's going to happen. But I actually sort of think it's a probability rather than a possibility.
Interesting. So, you know, people talk about nominal highs in gold all the time. And I know you do as well. And that's why I was very careful to say nominal all-time high when we started this. Yes, and I know you pay attention to that. So if you adjust for inflation, what would be in USD the inflation-adjusted high for gold? I
have not done the work. But again, to quote J.P. Morgan Chase, who knows a bit about the gold business, they suggest that it would have to clear through 2750 to be in inflation-adjusted highs. But I would tell you, we're probably getting deeper in the weeds than you want, but I like getting deeper.
No, this is great. This is great, Rick. I appreciate it.
The inflation statistic that they use is the compounding of the CPI, and I think that's an invalid statistic. The CPI will tell you that inflation is running at 2.7% a year. I define inflation as the deterioration of the purchasing power of the U.S. dollars involving the basket of goods and services that I buy. And the CPI is a flawed index. First of all, when it's inconvenient, it doesn't include food or fuel. Your viewers can look at me and see that I like to eat. And so an inflation index that doesn't allow me to eat is of limited utility to me. Secondly, it's hedonistically adjusted, which is to say that the people who set up the index arbitrarily assign values to the home I live in or the apartment I rent or the computer I buy, not related to the market price I pay, but relative to the value that they assign to the utility that I enjoy from that item. Again, colloquial English, bullshit. But the biggest problem I have with the index is it doesn't include tax. The largest component of most working Americans' cost of living is tax, greater than shelter, food, health, and fuel combined. And the idea that a cost of living index doesn't include the cost of tax makes it silly.
Great point.
I do a thought exercise, not attempting to be statistical or even accurate, where I try to measure the deterioration of the purchasing power of my savings relative to the basket of goods and services that I require to live my life. I'm not suggesting, by the way, that tax is a service, but I have to pay it. And I believe that the purchasing power of the basket of goods and services that comprises my life means that my savings are deteriorating at about 7.5% compounded. If you then had adjusted the J.P. Morgan Chase real gold price to view inflation as the deterioration in the value of the goods and services that you could buy, rather than adjusting it by the CPI, then the real gold price number is much higher. Mm-hmm. And I think that that's a valid argument. I don't think it's an argument that's going to make sense to the population until it does.
Just jumping back to metals. So again, I mentioned, your uranium call was spot on years in advance. We're in the bull now. Yep. I did very well listening to your advice. I bought kind of the top dog in the space in my view, which was Cameco, and did very well. And I owe it to you, so thank you. Now, I know you like to look at forgotten metals. Yep. If you had to pick one today, what would be what do you like that's overlooked in the metal space?
It wouldn't be a metal. It'd be North American natural gas.
Interesting.
People hate it. It's stupidly cheap. It's produced as a byproduct of producing oil. But that low price is discouraging primary gas production at the same time that it's encouraging consumption. We're building natural gas transmission infrastructure like mad. We're relocating European petrochemical and fertilizer plants from Germany to the United States, and we're building liquefied natural gas facilities like mad. The cure for low prices, Aaron, is always low prices. So I would start with North American natural gas. If you have the courage for political risk, I'd look to Canadian natural gas, where their Prime Minister, Mr. Trudeau, for some odd reason, is trying to de-emphasize the industry that his country is best at.
Well, he says there's no business case to ship it to Germany.
Despite the fact that the Germans want to buy it, the Japanese want to buy it, there's no business case because he won't allow it. Meanwhile, you can buy the top pure-play Canadian producers, the Peytos, the Birchcliffs, at extraordinary discounts to net asset value at normalized gas prices, and enjoy 7% dividends. You don't have to worry for me to be right because you get paid while you wait. The key in resources, Aaron, is to look for a commodity where ongoing demand for it is assured because it's required to maintain our standard of living, where the cost of producing the commodity on a global basis is higher than the price that they receive for the product on a temporary basis. In that circumstance, either the commodity price rises or the commodity becomes unavailable. When I suggested that you buy uranium, the stuff was selling for $20 a pound. Fully loaded, it cost the industry $60 a pound to make it. So the industry was losing $40 a pound and being dumb miners trying to make it up on volume. But either the price of uranium went up or the lights went out. Those were your two choices. Fast forward, or not even fast forward, at the same point in time, during the COVID experience, the price of oil, went to zero.
Yeah, worse than that.
It hung around $20 a barrel for a long time. Now, $20 oil, when it cost the industry, again, $60 to make the stuff, $65 to make the stuff, meant that the value proposition was understandable to your listeners by asking themselves a question. In 5 years, will the price of oil escalate to the cost that the industry price where the industry earns its cost of capital, or will my car not start? This is simple stuff. Truly simple stuff. So if you look, maybe not today, but you look forward at industries that are approaching liquidation and commodities that aren't merely boring investors, but investors hate, besides oil and gas, which is the obvious candidate today. The oil price is fine, but the gas price is not fine, and investors still hate the oil industry. What do they hate? They hate lithium. The price of lithium went up sevenfold, and it fell by 80%. We were never short of lithium. We were short of lithium processing capacity. We've looked for lithium, and we've found it, and we have a tremendous oversupply. And all of the people who loved lithium a year ago are starting to regret that they can even spell it. And that hate is going to continue, and it's going to exacerbate. There's no hate as sincere as the hate of a jilted lover. And lithium probably has 500,000 jilted lovers. What that means is that 2 years from now, lithium will sell at a discount to the cost of producing it. And those low lithium prices, combined with advances in battery technology, will sow the seeds of a recovery. But investors will be so disgusted, like they were with uranium in 2022, that they'll ignore the obvious. Platinum and palladium is another example. I'm not saying buy lithium today or platinum and palladium today.
Right.
The platinum and palladium prices are falling for two reasons. One, the big thinkers of the world. You know, Joe Biden, that noted materials physicist Greta Thunberg,
Right.
are suggesting that the internal combustion engine will go the way of the dodo in 2030. And so demand for auto catalysts will go away too. But the internal combustion engine is going to be with us for another 35 or 40 years. And unless there's a sudden resurgence in demand for smog, demand for platinum and palladium will continue too. It costs today about $120 to buy enough palladium to enable the sales of a $50,000 or $60,000 car. If the palladium price doubled, it wouldn't impact the finished price of the car. Meanwhile, one of the reasons that the prices are falling is because the second largest producer of platinum and palladium is Russia. And it so happens they need money. Just like in 1990, the last time they needed money, they did it by selling everything they had in inventory, including platinum and palladium. And platinum and palladium really, from a functional viewpoint, are only produced three places: South Africa, Zimbabwe, and Russia. South Africa is a basket case. Zimbabwe aspires to be a basket case. They're not even a basket case. And Russia obviously has some challenges too. If there were political or social reasons for a disruption of supply in any of the three of those countries, and I'm not saying there will be, but if there were, I think you'd see prices double. So I'm attracted to them as well. I'm also attracted, because it bores people and because people don't understand it and they're coming to hate it, with the rare earth space. Rare earths aren't rare. We haven't found them because we haven't looked for them. And we haven't looked for them because the Chinese produce them so cheaply that nobody can compete. They produce them so cheaply because the environmental standards associated with their extraction in China were ridiculously low. But the Chinese aren't tolerating that anymore, which means that the costs of producing these things are increasing. Meanwhile, there are strategic and geopolitical reasons why people are looking around the world for rare earths. They're finding them. 4 years ago, that was a big theme, and the price of rare earths went crazy. And the Chinese responded by manipulating the market, and now people hate rare earths. Although nothing has changed, the narrative has changed. Large, metallurgically acceptable deposits of rare earths outside China will, over the next 5 years, have extraordinary value. And nobody cares because rare earths aren't sexy. So I like them.
What is metallurgically accepted? What do you mean by that?
You have to be able to take the rock that hosts the rare earths, and you have to be able to extract the rare earths from it in a saleable product for a reasonable cost with an environmentally acceptable effluent after extraction.
Which is the challenge in the West, is it not?
All three of them are challenges. Rare earths aren't rare, but we haven't looked for them. We have a great rare earths deposit in California called Mountain Pass.
Yeah, I've been there. I've been to the mine.
It's been bankrupt 3 times in my career.
Yeah. Crazy. I think that breakdown, that was awesome. Just some of the sectors and minerals and commodities to look for. I agree with natural gas, and that's music to my ears. I live in Alberta. I live in Calgary, so I'm a big fan of the energy patch in this country. I think it's done wonders for Canada, and will continue to. So you've been in a lot of businesses. You're a serial entrepreneur. You've been an investor. I mean, for people like me, you've been an educator. I think you started a bank and sold the bank. You have a new bank, and you have the Rule Investing Symposium that you do. Now, there's a lot of natural resource investing conferences, as you know.
Right.
Why? You've been an entrepreneur that seeks to fill gaps, to fill needs. So why another investing conference? What's missing? What are you providing that the others aren't?
Well, a couple things. First of all, it's not just another investment conference. It's the best natural resources investment conference on the planet. And it's existed for about 30 years, which means it's stood the test of time. How has it done that? Really 5 ways. The first is that we've assembled a great list of big picture macro thinkers. Jim Rickards talking about the structure of the financial system, doing it as the former chief counsel of long-term capital management that almost brought down the global financial system. Daniela DiMartino Booth talking about the U.S. Fed because she worked at the U.S. Fed. Nomi Prinz talking about Wall Street because she was an analyst at Goldman Sachs. People who explain global macro to you, not the way that the CBC or your prime minister might, but rather the way that the global financial system actually exists. Once you've absorbed that, we bring you analysts and portfolio managers who've been active making money and resources for 30 years. Not some young hotshot moron investment banker who lost money in technology, lost money in crypto, and lost money as a supermarket analyst, but rather people who have made money where the rubber meets the road for 3 decades. Much more importantly than that, though, Aaron, we've had a feature for 3 decades called The Living Legends, where we assemble entrepreneurs who have built multi-billion-dollar natural resource companies from scratch. They tell you how they did it. They tell you the mistakes they made. And they tell you how those lessons made them better investors and can make you a better investor too. And I ask them point blank from the stage, tell me 3 companies that you don't run that you're invested in and why.
Nice.
Very useful.
Yes.
Beyond that, at every other investment conference that I know of, the exhibitors are treated as advertisers. The qualification to be an exhibitor is a check that cashes. At my conference, a public company exhibitor has to be owned in accounts owned and managed by me. Now, that doesn't guarantee that every stock I buy goes up, unfortunately. But it does guarantee that I've vetted every single exhibitor with my own money and with my staff. Finally, this. Ours is also the only investment conference in the world that I know of that offers a full money-back guarantee. If you come to Boca Raton, July 7th through 11th, or if you enjoy the conference from the comfort and convenience of your own home via live stream, and you don't think for any reason that the curriculum doesn't match the tuition, email me. I'll give you your money back. So the financial risk is mine. Now, in 30 years of selling investor-related educational products, I've had to refund about 0.1% of the tuitions I've charged. But that notwithstanding, you asked the question, what sets mine apart from other investment conferences? And that one single feature, gold-plated money-back guarantee, is your guarantee that I really have created a better product than other people, because no other people will guarantee that for you.
And so for investors who can't make it to Boca Raton, they can watch online.
They can watch the live stream, and the live stream will be available both to physical attendees and live stream attendees for 12 months after the conference.
Perfect. So it's on demand as well.
We're going to give you 60 hours of programming in 4 days. You can't absorb it. You can't. You absolutely have to watch the recordings, and they'll be available to you. Let me offer your viewers one more thing for free, if I might.
Please.
Any of your viewers who care what I think about natural resources can personalize it for free. Go to my website, ruleinvestmentmedia.com. List your natural resource stocks. Please no crypto. Please no pot stocks. Please no tech stocks. Please no muni bonds. Natural resource stocks only. I'll rank them for free, 1 to 10. I'll comment on individual issues if I think my comments are worth something. And that's absolutely free. I look forward to doing it. I've done it for 80,000 other investors in the last 7 years. So I look forward to doing it for your listeners.
And again, free for the viewers. That's a fantastic offer from an industry vet with a stellar track record. Rick, thank you very much for your time today. Take care, man.
A pleasure. Thanks for the opportunity.